Let us find what are some of the simple steps to analyze company with strong financial statements. What are key ratios to look for? To start with, let us look at ROIC. ROIC is return on invested capital. Return on invested capital is a profitability or performance ratio that measures the percentage return a company earns on its invested capital. ROIC is calculated by dividing the net operating profit after tax by the invested capital. ROIC is used to assess how effectively a company allocates its capital to profitable projects or investments. It helps investors evaluate the value of a company and compare it with other businesses. A company is considered to be creating value if its ROIC exceeds its weighted average cost of capital, WACC. Analyze the last 5 years of annual reports and find if the ROIC of the company is greater than 12%.
The next important attribute to analyze is debt structure of the company. Here we ensure the company has efficient debt management. There are 2 ratios to look at. First one is current ratio and second one is debt to EBITDA ratio. Current ratio and debt to EBITDA ratio are key ratio to evaluate the company's debt health. The current ratio is a liquidity ratio that measures a company's ability to pay off its short-term obligations or those due within 1 year. It is calculated by dividing the company's current assets by its current liabilities. The debt to EBITDA ratio is a financial metric that measures a company's ability to pay off its debt obligations. A good financial statement will have current ratio greater than 1 and debt to EBITDA ratio lesser than 3. It is calculated by dividing the company's total debt by its earnings before interest, taxes, depreciation, and amortization. A high debt to EBITDA ratio indicates that a company has a large amount of debt relative to its earnings, which could make it more difficult to pay off its debt obligations. Banks often use this ratio to assess a company's creditworthiness when considering a loan application. It's important to note that the debt to EBITDA ratio varies by industry, and what is considered a good ratio for one industry may not be the same for another. Generally, a ratio of 3.0 or lower is considered acceptable, while a ratio above 4.0 may indicate that a company is taking on too much debt.
Finally, the most important factor for any company or business, not just the past performance, but the future outlook as well. Future growth rate is an important factor to analyze. While we have analyzed past 5-year statements for consistently growing ROIC, free cash flow and profit, it is also important how company is going to perform in future. This is more art than a science. Various analysts and platforms arrive at growth rate in next 5 years. You can look at Yahoo Finance or GuruFocus.com for earnings per share for next 5 years. If company is projected with double-digit growth rate, it is considered to be good business. In my next video, I will show you how to look at the growth rates and find valuation for the company. Let me know if this would be something you are interested or let me know what you like to hear. If you want to learn how to apply finding valuation to add stocks to your own portfolio, make sure to subscribe to my channel and hit the bell icon so you don't miss any of my videos.